Hey everyone, Mark Hart here from MIP. Super excited to teach everyone about apartment syndication. So this is going to be a beginner's guide to what is an apartment syndication. And we want to go and touch on some of the key items that make up a syndication, right? What is it? What are the documents that are used? What are some of the structures that we see? Just so you can better be prepared for the future if you ever are interested in learning more about one of these types of investments. So we do have a disclaimer that this is not an active offering, right? We are not trying to raise money. We do not have a deal that we are trying to invest in and buy currently. This is just for educational purposes only. We just are here to teach you the basics, teach you the building blocks of an apartment syndication, and would love to be able to touch base, personally after this webinar, if this is something that you have additional questions on or are even somewhat interested in. All right, so let's get started here. Sorry for my little camera. All right, we'll move that. So at the top here, the primary investment objective of the company is to acquire, finance, manage, and dispose of the property in such a manner as to provide its members with a return on their investment and to eventually sell or exchange it for another property, right? That's the textbook definition of what this syndication is and what the goal of the company is. And so now what does that actually mean, right? Well, here's a really great little picture here. So this is the structure of a typical syndicated group investment. And at the top, we have this nice little building, right? We focus on apartment buildings, but you can buy all different types of buildings. And so let's say we have a building here in Memphis, Tennessee, as an example, right? Well, what we're going to do is we're going to create a limited liability company. So a lot of great perks of having an LLC. Number one is the protection of liability. And then also we're going to name this company, this brand new company that we're starting after the actual property itself. And this new company is going to go and buy this individual complex, this individual apartment building. Within this company that we're starting, at the bottom left, you'll see general partners, and the bottom right, you'll see limited partners, right? It goes by GP and LP. Those are the little slangs. So bottom left, general partner, that's going to be me. That's going to be my partners, Jim Reedy, Brad Reedy, Sean Taggy, so on and so forth. We're also called the sponsors, another nickname. We're just the ones that put in the majority or all of the sweat equity, right? We are here to put this all together, right? If it wasn't for us, there wouldn't even be an opportunity available. So we go out, we find it, we finance it, we manage it, we try to create a return on investment for our members. That is our job, right? It's very active. We are extremely involved in the day-to-day as a general partner. So we're here to operate the asset and the business plan that is set forth in this limited liability company. So we're here to contribute our expertise, right? That is one of our biggest assets that we actually have, right? You should have a sponsor that has done this before, that knows the market, knows real estate, and just understands how to provide a good return on investment from the asset class. The GP will also contribute capital, right? We can invest as well, right? We love investing. And so that's something where we should be able to put in a portion of the investment to buy the building, but not all. The general partner will receive fees and equity, so profit, for doing this entire investment, assuming the asset performs. Then essentially, well, what's the point of having a limited partner? Then you might ask, or why even bring in investors? It's because the goal is to go buy a large asset that's so big that I don't have the capital, I don't have the cash sitting in my checking account to personally be able to buy one of these deals ourselves. So what we do is we say, hey, why not pool our resources together, create a company, and bring in limited partners, where all the limited partners is they're very passive. This is one of the most passive, hands-off. This takes very minimal time on the investor's side of things. So you're going to read over all the legal documents. We'll dive into those in a minute and say, you know what, I'm interested. So you're going to be a equity investor, right? You're going to have an actual ownership percentage of the asset. So it's kind of fun. You can say, oh, I own 3 doors out of the 100 units, right? If you own 3% of the company, it's got 100 units. Well, that's like owning 3 doors, right? So it's like owning 3 rental properties in theory. And so you will get a portion of the cash flow in the form of dividends, and you'll also get a portion of the equity when the asset is actually sold. So essentially, this partnership here, very simple way to think of it, put your single family cap on and you say, hey, here's a single family deal. Let's say you found a single family deal, but you don't have the money to buy it. Well, you bring in a partner and you split the profits, right? That's exactly what we're doing here, just on a high level, large scale with hundreds of units and a multi-million-dollar asset. So next up is, well, what are these legal documents that we're creating? And the first one and the most important one is the private placement memorandum. It also goes by a PPM. This document will tell the story of the overall investment. This is probably one of the most important documents for you to be able to become a master of. I recommend reaching out to, multiple companies and requesting their PPMs and just reading them entirely, because essentially every PPM is going to be a little bit different, right? No two PPM is going to be exactly the same. And so you want to be able to familiarize yourself with the terms inside of that PPM to see if it's a good investment for you. Legally, the PPM is a disclosure document required by the Securities and Exchange Commissions, the SEC. Now, this memorandum describes things such as the structure of the company, projected distributions to investors, compensations to managers, to us, the risks of investing, potential conflicts of interest, and a summary of how the company will actually be operated. So next up, right, operating is the operating agreement, or the OA. So this agreement describes how the company will actually be run. So legally, it is the governing document for the company operations and describes and details the rights and duties of the members, which is you as the actual investor, and the manager, which is myself, as the general partner. So this is more formal, right? How will meetings and votes of the members be conducted? How and when cash distributions will be made, where the company books and records will be kept, how disputes will be resolved, allocations and taxations of profits and losses, how the company will ultimately be dissolved, and the agreement is the contractual enforceable contract between the members and the managers as to the operation of the company. So there's a lot of similarities between the operating agreement and the private placement memorandum. So you will need to read both documents to really understand the pros and the cons of the individual investment or the company that you'd actually be buying into, essentially. And then one of the final documents is the subscription booklet, or the SB. And each investor must review, complete, and return the subscription booklet to the manager in order to invest legally. So this contains the qualifications and suitabilities to invest in the offering, right? Sometimes you need to be an accredited investor. Other times you need to be a sophisticated investor. So you need to fill that information out. The amount the investor is planning to invest, and then the managers, myself, acknowledgement of the investment, and it's essentially your receipt as well. So it's very, very simple to invest, right? You read the PPM, read the operating agreement, read all the marketing material. There's normally a PowerPoint presentation, right? Do your due diligence, ask as many questions as possible. But if you're ready to invest, you fill out the subscription booklet, sign it, wire in your money, and then you sit back and pray, right? You don't have any day-to-day operational obligations like you would on a single family turnkey, right? As a single family turnkey, you get to make the decision on, should I sell the asset this year or should I sell it next year? Who do you want the property manager to be? You get to make the decisions on what type of maintenance and deferred maintenance to fix, or what type to just wait and push out for the next year or two. But you don't have that here on an apartment syndication. With an apartment syndication, you're giving away your basically day-to-day rights to operate the company to the manager, right? To myself, because we've got the experience, and you are just looking for a way to passively invest, reduce the amount of time that you need. You don't want to create another side job. You don't want to be an active investor. And essentially, a lot of folks, they live 1,000 miles away, or they live in Australia, right? It's very difficult to buy an apartment building in Memphis if you live in Australia. So next up, you're going to see the formal names. This is called a Regulation D of the tax code, Rule 506C versus 506B. So there's two, and they're different. Very, very, very important. So 506C is in Charlie, which requires the manager to take reasonable steps to verify that each investor is an accredited investor. And so essentially what that means is you have to be accredited investor to be able to invest in the individual offering, right? You'll go to your CPA, or you can go to a company like verifyinvestor.com, and they can get you a nice formal letter that says that you are accredited. And the reason why companies choose 506C is because, let's say it was an active offering, well, then you could go online, you could go on Facebook or Instagram or Google Ads and on podcasts and say, hey guys, shout it from the rooftops, I've got a deal, I'm raising $5 million, who wants to invest with me right now? And you don't need to know who these people are, right? You are marketing to find new people, essentially, but you can all those new people must be accredited. So now the other option is a 506B as in boy, which allows you to accept accredited, but also up to 35 sophisticated investors, which is one that does not have as much of a net worth and income as an accredited investor, but is assumed to have the capacity to understand the fundamental aspects and merits of an investment in a company. So essentially, what that really means is, do you have a relationship, a prior relationship with us? So let's say you're a sophisticated investor, you don't qualify as an accredited investor, and you bought some single family turnkeys from us. That is a relationship, right? So now we can present a 506B as in boy opportunity to you, because we met based off the single families, but now we are sharing another opportunity, and you can actually invest in that deal. So that's the benefit of the 506B. Now, the con is that the 506B is, we cannot go on podcasts and we cannot go on webinars like this and say, I have a deal, I want to raise money, right? You cannot do that in a 506B. That's what the 506C is for. So for accredited investor, and you can Google the qualifications, there's multiple to be able to see if that is you or not. Next up is going to be the manager versus the member, right? And pretty simple. The manager is the general partner, right? That is us. We make the investment decisions on behalf of the company, right? We're the ones that are doing essentially all the work to make sure that we can create a profit and a return on investment for everyone involved. Then the member, which is you as the limited partner, well, the company will sell units or interests to investors. So you're actually going to buy these units or interests at a set price. And that allows the company to raise capital, so we can have the organization of the company to pay for property expenses, including the down payment, due diligence, loan fees, closing costs necessary for acquisitions of the property and repairs and maintenance. So in theory, the members, the limited partners, they bring the money. The managers, general partners, ourselves, we do all the work, and then we split the profits, right? Pretty great relationship between the two. Next up, right? Well, what's in it for you, right? As the limited partner, as the member, why even invest? So number one is you'll get cash flow from distributions of operations. So cash distributions from operations. So meaning we buy the asset, We own the asset. Now you're going to get, assuming it's available, of course, distributions. Could be monthly, could be quarterly. Everything depends, right? So number one is going to be something that you might see, a buzzword called a preferred return. And a preferred return, think of that as just simple cash flow, right? After all the expenses, investors get all of the cash flow until they get a certain percentage each year. So essentially what that means is we're not splitting the profits until you get a certain percentage of cash flow each year, meaning you get all of the cash flow until we get to that certain, cash or ROI amount. So what's the benefit of that? Well, it says that we have to be we have to succeed in order to get a piece of that cash flow. So we have to do better than the preferred return before we as a general partner get a split of that cash flow. You'll see the preferred returns from 6 to 10%, and some people might not have it at all, right? Because it can be a little bit confusing to people, and other people might just want to split every dollar 50-50 or 70-30, right? So it's normally better for you as an investor to have a preferred return because it just shows that the operator, manager, ourselves is very confident that the deal is going to do well. Next up, when it comes to preferred return, a very important word in the PPM is going to be cumulative or non-cumulative preferred return. So essentially, let's say you buy an asset and you know what, year one, we had to spend a lot of money renovating it and raising rents, and we didn't get any cash flow. So what happens to that preferred return? Let's say you've got a 6% preferred return year one, right? You're supposed to get that 6% of that first cash flow amount. And essentially, there was none to distribute. So now it's year two. And let's say there is cash flow in year two. Well, if it's cumulative, which is better for you, you want cumulative, that means the payment, you got to get reimbursed for all of year one. So you got to get your 6% for year one. So let's say you invest $100,000. You need to get $6,000 in cash flow to fill you up for year one, and then $6,000 in cash flow to fill you up for year two before we as the managers start getting a piece of that cash flow, right? Pretty great. Then next up is the equity split. How do we split the cash flow after this preferred return? And everyone's going to be different. You'll see 50-50, 90-10, 70-30. The way you kind of look at those equity splits is essentially, well, how good of a deal is it? Number one, if someone bought the deal and it's a new construction deal, A class, the numbers are super thin, they bought it on the market, they had to, bid against a bunch of other people, you're probably going to get something like a 80-20 or a 70-30 type of split. Meaning for every dollar after the preferred return is met, so let's say as an example, you invest $100,000, you have a 6% preferred return, you get $6,000 year one of cash flow, but now there's one more dollar left over. How are we going to split that dollar? And essentially it's that ratio. Is it 80-20? So 80% goes to you, 20% to me. Is it 50-50? Half goes to you, half goes to me. And so essentially that percentage is what's baked into the underwriting of the deal to make sure that, you can get a good return. We can model it out to make sure that you get a good return. So if the sponsor buys a really great deal, they buy it off market, it's expected to have a really great, return on investment. You might see a equity split of like 50-50. If you buy something that is, new construction, slim margins on the market, you might see 80-20, even 90-10, right? So that's kind of the difference between the ratios that you see. So the big one is that it doesn't mean one's a better deal for you. If you see 90-10, so you get 90% of the profit and the sponsor only gets 10, that doesn't mean that that's a better investment than, let's say, a 50-50. It just means that the margins are tighter, which could also be riskier. So each thing's got its own pros and cons. More than happy, to dive into that. So you've got your cash flow, right? That's pretty simple. That's ongoing as time moves forward. But next up, what about the cash distributions from a capital transaction? So a capital transaction means that you're going to do either a cash out refinance or sell the individual asset. So from a cash out refinance standpoint, think of it like the value add strategy or a BRRRR, essentially. You buy the property, renovate the property to increase the value, refinance at that new higher amount. And then once you've done that, hopefully you can give some of your original investment back, right? And have none of your own money in the deal, right? That would be the dream. And this is basically breaking down how you would get paid for that refinance and then also the sale of the asset. For these individual syndications, most of them have an end date, meaning we want to sell the asset at year 5, 7, 10, something along those lines. So how are we going to give that money back when we refinance or sell the asset? And number one is you have to receive 100% of your initial capital contribution back. So you invest $100,000, you need to get your original investment back. So number one, boom, we give you your 100 grand back. Then number two is until you received all of your preferred returns. And if it's cumulative, that means you got to go back retroactively and get you that, let's say it's 6%, 6% year 1, 6% year 2, 6% year 3, and make sure you got that 6% every single year. And then once you've hit that 6% amount, then everything will get split based off of the equity split that we talked about before, whether that's 50-50, 70-30, 80-20, right, as specific examples. And the good part about this is that for a lot of these syndications, once again, they're all different, but for ours, there is no cap on the upside. Right, you have essentially unlimited upside potential. So if the deal just crushes it and we do extremely well, cap rates compress, rents go up, right, interest rates go down, right, we're selling these assets in year 5 or year 10. So it can be a different economic environment than what we're in today, which is really exciting. And let's say you smash the deal and essentially we're just going to split that profit in this example 50-50 all the way until until we've given back all of the cash that is available in the form of a net profit. So next up, it's a lot of work, right, for us as the manager, as the general partner. And so if we're going to charge fees, just like you would see from a property manager or you'd see from a lender, right? They get fees for doing the work and the compensation. And the number one fee, or these are just some of the common fees that you'll see to just be familiar with. One of them is the acquisitions fee. So this is the compensation for the manager's efforts in conducting due diligence on the property and making this investment opportunity available to investors. So essentially, you don't just buy a deal, the first deal that you see, right? We have to go travel to properties, sometimes different markets, right? We have to spend money on all of that. We are spending our time analyzing countless deals, spending countless hours, huddling up, making offers, doing our due diligence, spending money on due diligence as well. And for deals to either just not pan out, and essentially because of all that, that's why we have the acquisitions fee to get us reimbursed. Then next up is the asset management fee, which is the compensation for the manager's efforts for oversight and management of the company. Essentially, once you always have a property management company in place, but with an asset of this size, right, you have to manage the managers. Might sound a little weird if you're not familiar with this space, right? If you're in the single family home space and you only have one asset, right, the property management company can really be on autopilot. But when you're talking with a $10 million apartment building, right, you need to make sure that you are poking, prodding, asking questions, reviewing the financials, and really diving into the individual asset and going above and beyond, because the more involved you are and the more intertwined and in sync with the property manager, then the better chance you get a good return on investment. And essentially, we're splitting the profits. So we're all in this together. And that's one of the fun parts. And then we also have capital transaction fees, which is the compensation for the manager's efforts in marketing the property for sale or refinance. So just what we talked about before, if we're going to refinance the asset, we just refinanced 3 assets, and it was a full-time job for one of our partners, Brad Reedy. Shout out to Brad. And it took him months. I'm talking every single day. Lenders asking questions and needing information. If you've ever done a refinance on a multi-million-dollar property, well, you understand the amount of time it takes. And that's just to reimburse us for that time. Same thing with the sale of an asset. Brokers, buyers, all going to be asking questions, needing information, poking and prodding, and that just takes time, right? And that's what the capital fees, transaction fees are for. Next up, the good part about all of this is, as the manager, we have a fiduciary duty. So we are acting as a fiduciary, which is very, very important. So we use our best efforts when acting on the member's behalf. As a fiduciary, we do not act in any manner adverse or contrary to the member's interests. As a fiduciary, we don't act on its own behalf in relation to its own interests. And as a fiduciary, we exercise all the skill, care, and due diligence at its disposal. So we put your interests ahead of our own, and that is a very special relationship, and one of the many reasons why these syndications are so popular. Now, with all that said, while yes, we're acting as a fiduciary, yes, we're splitting the profits, yes, we want this deal to exceed, because then that allows us to go and grow and do more deals. There's a lot of risks, okay? And the PPM is going to dive into all those risk factors. We got a bunch of them on the left-hand side. Essentially, we'll let you read all of those and just fire through. But essentially, you could lose your investment, right? There's risk of lack of diversification. We're only buying one per apartment building, right? We're not buying 100. The due diligence, we may have missed something. Essentially, the success of the company depends on the manager's ability. What if you go with a manager that's never done this before? Well, that's risky, right? Versus someone that has done this and owns thousands of units. Lack of control and limited voting rights for Class A and B members. So if you're a member, right, you don't have a lot of control, just like what I said before. So that's also a pro, because it means you have limited time in the investment. And you're admitting, hey, I'm not a real estate expert and I don't have any time, right? But that also means that you have to trust the people that you're partnering with, because they're the ones that have control of the company. Then limited transferability or liquidity of the interests. It's not a stock. You can't just click a button and sell it. While sometimes you can sell your individual interests, it takes longer. It's a little more complicated, but these are long-term investments. You need to be investing your retirement money. When you have those 3 buckets of money, you have your now, later, and never buckets. This is your never bucket. This is your generational wealth. I want to pass this on. And that is why you can invest in your retirement accounts, which is nice to know as well. So a lot of things that could go wrong, right? So, hey, well, why would you want to even invest in something like this when all these things could go wrong? It's like, well, if you find the right team, the right asset, the right market, and just put this all together properly, you can really get a great return on investment. And that's exactly what Sean Taggy is going to dive into next. He's going to go into one of our previous deals that we have actually done, so you can actually see what the numbers look like, what does a deal look like, and what is the actual return that we've been able to achieve, and something that we're extremely proud of. So thank you guys, for listening. Hopefully you found some really great value. If you want any recommendations for books or knowledge on where to go to learn more about apartment syndication and being an investor, please let us know. And this is something that we are very, very passionate about, and something that we would love to be able to talk more about in the future one-on-one. So off to you, Sean. Thank you guys very much.